Hi guys, welcome to a new format at Capitalmind, and today we're going to look at how to generate cash flow in a tax efficient manner. This is a small tutorial on using liquid funds to generate cash on a monthly basis and the different ways you can use it if you're an investor, if you're a retiree, or if you're a trader. Even there's a good use for this even there. So I have with me Deepak Shenoy. And so Deepak is going to walk you through all of this. It's a small tutorial. I hope we can share the spreadsheet we're going to use to explain all of this to you. And there you go, Deepak. Please take it over.
Thanks, Vashisht. We've got an interesting presentation for you. We're going to do a crazy set of things with a liquid fund. These are liquid mutual funds. They typically invest in extremely short term, so low risk paper. But one thing is opened up. They give you about 6 to 7 to 8% returns. And one of the things that's really changing is how they can be used for a tax efficient purpose. Now, let's say you've got a bunch of money. You're retiring, you're getting a bunch of money. You want to earn about 25,000 rupees per month. That takes care of your expenses. You've got other sources of income, so you're still taxed at a fairly high rate, but you want to use this 25,000 as a constant source of income that you don't have to worry about. Now, let's go and do a little bit of a calculation. First thing that we're going to do is we're going to go and look at 25,000 rupees that you need per month. So we've got a little Excel sheet for you. We're going to share the spreadsheet later. This 25,000 is what you need every month. The market is giving you about 6%. I'm just making an assumption. It's a little greater right now, but take 6% a year. To generate 6% a year, you'll need 50 lakh rupees. And this is an auto calculated in this Excel sheet. It's a simple formula. 6% of what is 25,000 rupees a month? And the answer to that is 50 lakhs. You're going to take 50 lakhs. You're going to assume a tax rate of 30% in your tax bracket. And I'll show you the other formulas at a later point. You start with 50 lakhs. Let's go down a little bit further. And I'm going to zoom out this sheet so that you can see this better. You're going to see on the month on the left hand corner at 100%. Well, here you go. So let's start with the first month. The first month actually shows you a corpus of 50 lakh rupees where you've bought 50,000 units of a liquid fund at 10 rupees NAV. So you've got 500,000 units at an NAV of 10. On the first month, the NAV bumps up a little. How much? You're getting 6% a year. That's 5 paisa on the 10 rupees that goes up. So it's 0.5% a month. 55 lakh units that you own now have gone up by 5 paisa per unit. You take out 25,000. Okay. Now what happens now is a very interesting thing. The number of units you have to redeem in order to get 25,000 is 25,000 divided by 10.05. That's the new NAV. So you get something like 2,487 units that need to be withdrawn. Now at 2,487 units, you bought these units at 10 rupees. You sold them at 10 rupees 05. That was redemption means. It means you've sold the units. So the 5 paisa is a profit. So you look at the column number H, it actually shows you the profit per unit. So that's 5 paisa on month 1. The actual profit you've actually earned is number of units you've sold into the profit per unit. That's 124 rupees. Remember, you've got 25,000 rupees out, and that 25,000 is all that the liquid fund actually generated in the market that month. But your taxable profit is only 124 rupees 38 paisa. The tax rate that you have is 31%, 30.9% currently. So the tax you're going to pay is about 38 rupees. You've taken out 25,000 rupees from your liquid fund and you paid a tax of only 38 rupees. There were a bunch of units remaining. So let's assume you take the tax out. What you've actually got left in your pocket is 24,962 rupees. This is an awesome deal. Why? Because a fixed deposit with the same 6% return, you get an interest of 25,000. You're taxed at 30.9%. Your tax is 7,725 rupees. In one instance, in the liquid fund, you paid only 38, and in the other you paid 7,725. It's a 200x difference. What's left with a mutual fund is with a fixed deposit is only 17,275. This is 44% more if you went to a liquid fund approach. The second month gets more interesting. You've got a bunch of units left. That's 4,97,512. That's column number D. The NAV now bumps up by another little bit, which is 10.10. So you've gone from 10 rupees to 10.05 to 10.1. You want to take another 25,000 out. You're going to redeem a certain number of units. Again, the same formula. It's 2475 units. The profit per unit now from 10 rupees purchase to 10 rupees 10 paisa sale is 10 paisa only. The profit here is 248. Your profit is increased because the NAV is increased. Again at 30.9%, it's about 77 rupees of profit, of tax. You're paying 77 rupees of the tax on the second month at when you've taken out 25,000 rupees. The first month you took out 38. Again, this is far more efficient than a fixed deposit. The third month, similarly, you sold at 10 rupees 15 paisa. There are lesser number of units, 2462 units this time, and your profit is 371 rupees, and 30.9% of that is still only 114. Add up the whole first year, the 12 months together, and if we go to if we add them all up, if we sum up column number let's just say K10 to K12, K10 to K12 upwards, so we will actually see the sum of the tax for the whole year. So the first year, if we see the bottom right, a little bit further lower, two more, yeah, there you go. So there's 2,943 rupees. This is all you've paid in tax, and you've taken out 25,000 rupees a month. That's 300,000 rupees a year. And yet the total amount of tax you've paid is 2,943 rupees. That's it. Versus if you do the same calculation for a fixed deposit, you paid 92,700. That's 30% of the amount you've taken out. The difference is enormous. 3,000 versus 92,000. It's insane. But you think, what will happen in the second year? What happens after that? Okay, so let's go to the second year. The second year, you add up everything, and you'll still get, for instance, from month 13 to month 24. So yeah, there you go. That's just the one left right of it. Yes. So another row, and then you get only 8,100 versus 92,000. You're not going to change 92,700 because the taxes remain the same for a fixed deposit. So you've got about 7,000 versus 92,000. The third year is, if you add the 25th month to the 36th month, you still have a tax paid of 13,000. Now this sounds like, oh, you know what, it's increasing every year. We started with 3,000, it's going to 7, now it's 13. Come on, you'll catch up soon. After the third year, the magic happens. In Indian income tax law, your tax actually goes down after the third year. Why? Because you bought the units 3 years ago, you get the benefit of something called capital indexation. So what happens really is that, you remember you bought the units at 10 rupees, and now on the 37th month, it is 12 rupees 3 paisa. That is the total, according to the interest rates in the market at 6%, it stayed constant, assume. You've now got something that was bought at 10 but sold at 12 rupees 3 paisa. The income tax department allows you to say, listen, I bought it at 10 rupees, but there was inflation. There was inflation of 5% every year. I can say that, listen, give me the benefit of inflation. That means don't assume that I bought at 10 rupees. Inflate my 10 rupees by the inflation amount every year. So I'll take 10% and I'll inflate it to 5% a year. So that's 10 rupees 50 paisa for the first year, 11 rupees for the second year, 11 rupees 50 paisa for the third year. It's a little bit more than that because of compounding, but my profit per unit after I reduce this inflated cost is only 0.45. So if you look at row number 46 and column number H, you've got 45 paisa of profit per unit. It's not 2 rupees 3 paisa, which would otherwise apply if in the earlier months. On the 37th month, your profit has fallen to 45 paisa because 12 rupees 3 paisa was your selling price, and your actual buy price would have been increased from 10 rupees to 10 rupees 58 paise. That's 11 rupees 58 paisa. That's the formula that indexes your profits. We have an article on this as well of how you calculate this, but suffice it to say your profit per unit has fallen to 0.45. The same formula goes in, and you look at the profit that you made on this transaction of 25,000 rupees. The profit is a capital gain of only 936 rupees 23 paisa. That's column number I in on the same row. At this time your tax rate will actually fall. Okay, so this rate we're going to change this to to about 20.6% because that's the lower rate of return. In spite of your tax rate being at 30.9, you will actually pay only 20.6% of this return. While we've calculated it at 30.9 itself, assume that the lower tax rate does not apply to you. Even at 30.9%, your tax has fallen to 289 rupees 30 paise. Added up for the whole year, it's only 5,800 rupees. Versus again, for the fixed deposit, you would have paid 92,000 rupees. And the same thing applies for every other year going forward. So if I go to sheet number 2, which is right at the bottom, I've actually tabulated it for all the years. The saving is intense. It starts with 89,000 rupees less tax you've paid for year 1 and keeps falling till about, even after 20 years if you did this, you'd still pay about 72,000 rupees less in the 20th year of operation. So it's really about the fact that you've managed to generate cash flow and saved an enormous amount of tax. Beat this, your corpus of 50 lakhs is still safe. It's still sitting with a liquid fund. You can get out of that anytime you want, just like a fixed deposit, and you don't have to worry about it. There are risks, of course, and one of the biggest risks is that the interest rates in the market fall. So you start off at 6% today, tomorrow it could fall to 4%. Day after tomorrow it could fall to 2%. In the US or in Europe, you have issues with 0% rates. But these are evidently, if these fall, your fixed deposit rates will also fall. So when you have to renew your fixed deposit, you will find it difficult to find the same kind of cash flow in any case. A liquid fund in an inflationary economy where interest rates keep hovering around the 4 to 6% range, you will still make this kind of return in a liquid fund. If inflation remains around 4 to 6%, you're going to make this return no matter what happens, and it's superbly tax efficient. This is a much better way to plan a retirement cash flow than it is to think of putting your money in fixed deposits. Fixed deposits do have one added advantage. They can give you a slightly higher rate. So you might be able to find a liquid fund that yields only 7% today or 7.5, whereas a fixed deposit could give you 8 and 8.5. Why is that very different? Is if you're in a much lower tax bracket. So if you fall in the 10% tax bracket, you will actually find it much more easy to go with a fixed deposit. But for most of us who might have other sources of income, rental sources or other sources of income in general, a liquid fund will provide a systematic cash flow that's regular. And here's the best thing, you don't even have to take the money out. You can leave it in there, and while you're not using it, the liquid fund can keep generating income. You will not pay a single rupee of tax through this entire time until you actually get the money out. So if you have other sources of income, use those other sources of income. When it's time for you to start redeeming it, you redeem it. If you cross the 3-year barrier, every part of your redemption now is going to be superbly tax efficient. You don't have to worry about taxes on interest that you've earned in the past years because you got the inflation to index against. This is how you generate cash flow from a liquid fund, a systematic withdrawal plan from a liquid fund. But I think, Vashisht, we've got a pretty interesting way to convert this into, trading capital as well.
Thanks a lot for that great tutorial. I'm going to do. So when I started trading, I used to do this, but I did it with an FD. So this is not the greatest, brightest idea right now. But if you are a trader, or if you have capital and you want to explore the world of trading, this is a great idea. And especially if you're going to go not the very directional route, but to take a more options kind of route, a non-directional approach, which revolves around taking advantage of volatility, then this is a great way to get started, because you can generate about 5. So let's go back to the sheet. Deepak, you mentioned 6% return here.
Yes.
So where do I go to find out where can I get a better return?
Okay, let's do this. Okay, let's go to value research. There's a bunch of interesting, liquid funds out there. Most liquid funds tend to invest in similar instruments, so you'll typically get a similar return. Always look at a liquid fund in terms of how much money does it have instead of how much returns it's earning. Some of these liquid funds have only 5 or 10 crores. They're not good. Their returns are not something that they can sustain over a longer time. If you're going to compare a debt category for, say, a week, a month would be good.
A month is the good benchmark?
A month is a good benchmark. It gives you current rates.
Top 10? Okay.
You just go for the top 10 funds on value research, and just look at the net assets if you can, or if you can look at a 1 month.
So ICICI Prudential Liquid Plan is, the rating is low, I don't know why, but the net assets are the highest.
Yeah, it's good because you can find out what kind of high rating funds, how much are they doing. They're approximately 0.65. You see the top 10, there's not much difference other than Escorts, which has very little money. At 200 crores is not much at all. So 0.65, so that's 0.65 per month. Now let's multiply 0.65 by 12 months, right? So you got that much that you can get in the market today. That's 7.8%. 7.8%.
Should we put this in our spreadsheet?
Let's do that. Let's put 7.8%. And let's do one thing. I wanna trade with, I don't want to lose more than 10,000 a month. So how much corpus do I really need to get started? Even 5,000. Let's say 5,000 rupees. Okay. So 7.69 lakhs.
So with 7.69, say 8 lakhs, or say 7.69, I have 5,000 rupees of cash flow each month.
Every month.
So that is, think about it, it's your risk capital. It's like risk-free risk capital. It's not, is it available in any other country with a market our size?
Well, only other country that has higher rates is Brazil, and I don't know how much they trade anything over there. So,
but so this is quite unique to us, where you can generate 5,000 rupees every month from a corpus, and this is your risk capital. If you can risk this to generate more money, for example, 5,000 rupees on a 75 lot Nifty is about 66 points worth of risk that you can take. In the strategies we like to trade, or I like to trade, that's a lot of risk. And if you even start with 1 lot Nifty, you can do high probability trades where you can generate 60 to 70. I don't know, depends on how you understand these things. It's a slightly steep learning curve, but if you can get there, say you got 40 points. So 40 points is 3,000 rupees.
3,000 rupees, yes.
Say you got 80 points in a month, you will have 6,000 rupees. Bear with me. 6,000 rupees. Say you start with 5,000 rupees the first month. You put 7.7 lakhs in a fund. 30 days later, you get 5,000 rupees. Now you need 1 more lakh or 1 lakh 50, let's say 1 lakh 20 more as margin to fund your trading. And the 5,000 as risk capital, you can place a trade. Probably you can make 80 points. So with 80 points in that month, another 30 days later, so 60 days from the point you began, you have 5,000 rupees here. Another 5,000 rupees for the next month's withdrawal from your plan. So that's 10,000. And if you were able, another 6,000 rupees from your trading. So by end of, in 60 days, you have from a point where you are going to risk your capital, you still have the capital intact, and you have 16,000 rupees of risk capital. So that's just one approach. You can be creative with it, and you can see how you can scale into positions, or you can scale into your position sizing. You can go larger based on this. It depends what you want to do. 60,000 rupees you can take, probably trade 3 stocks and deploy a lakh or 2 lakh rupees of money. And if you're using a stop loss, if you're trading options, there are hundreds of ways you can use this.
Well, there's also, if you're not comfortable with options, you can do stocks. So you got 5,000 rupees the first month. Let's assume you wanted to buy Reliance shares and they're at 800 rupees a share. I could say, listen, I can take a 10% stop loss. So 80 rupees I can lose per share of Reliance. What then I should do is, I have 5,000 rupees to lose. I don't want to lose more than 5,000 rupees. So if I take 5,000 rupees and divide it by this 80-point risk that I'm taking, I can buy about 62 shares of Reliance. So if I took 62 shares of Reliance and I maintained a stop loss exactly at 80 rupees.
So with 62 shares, you can actually deploy about 48,000 rupees.
Yes, 48,000.
So 50,000 rupees you can deploy. From the risk capital you've generated using your original corpus.
So in the end, even if you lost these 80 points, after the end of month 1, you would still have your 7.69 lakh sitting in the liquid fund.
Generating 5,000 rupees every month. So it's just one way to look at risk management. It's a way to fund your risk, and you can use it for stocks, you can use it for any other strategies you find interesting. I would like to use this for options, but that's my choice. So that's one way to do it, and I hope this whole tutorial was very useful to you guys. And thanks Deepak for the excellent spreadsheet. I hope we can share this, right?
We'll share this. You can look in the comments in the YouTube, or you can look at our webpage, capitalmind.in. We'll have a bunch of stuff out there that follow this. But think of this. Keep your idea as a portfolio as a whole, not individual trades. You don't think of Reliance as one trade, liquid fund as another trade. It's all about the total amount of money you have at all times. If we keep that with controllable risk, you don't really have to lose money. And that's the point we want to bring to you. Thanks so much for watching.
Thank you guys. Bye.